Okay, welcome back to the podcast, everybody. I'm Jared Johnson. We are happy and lucky to have David Morgan, the founder of the Morgan Report, joining us today. I think we have some really good stuff to talk about. David's focus is in an area that I think a lot of people have been paying a lot of attention to, certainly this year. So we're going to talk, as you like to say it, money, metals, and mining. So let's dive in on some of that. But tell us about yourself for just a moment before we dive into all the details.
Well, my favorite topic, me, right? There's a bio on the webpage, themorganreport.com, but basically I've always been interested in money and finance. Got out of high school, went to engineering school, Cal Poly, San Luis Obispo, degreed engineer, aeronautical engineering, had a flying career as a contractor to the military. It was called the JTF, Joint Test Force. I was a crew member on the B-1 bomber, and then I got picked up by the Skunk Works and worked on the F-117, which I can say because it's not a black program. The whole time I was in there, I was also kind of moonlighting, had a real estate license, an insurance license, and was working for a CFA, Certified Financial, or CFP planner. So I was interested in both. Love my aircraft adventures. I'll put it in those terms. I'll keep it vague. Mm-hmm. But financial markets really where my heart was. And after I left the aircraft industry, I started the website. Actually, the original was silverinvestor.com, but I changed it to Morgan Report early on because I did all the resources. We were the first on rare earth elements. No one could spell it in the early days. And we looked at cobalt and lithium and copper, uranium. We've done well in the uranium sector. But the top tier of a financial conundrum, which we've been in for quite some time, and it's now coming to the fore where more people are waking up, are the money metals, gold and silver. So that's where I've spent most of my time, Jared.
Yeah, that's great. That's great. And I think, I mean, for all the years that I've been in the market, it feels like gold and silver have they pop up here and there, right? We hear about them, they get some attention, people are always buying and holding, but certainly this year we have seen one heck of a rally. I think gold is up about 50 some percent year to date. Silver's up almost 70% year to date. So there's some pretty big performance going on there. Now there's the obvious things of this is inflation. This is part of the debasement trade. This is government panic. But give me your take. Why this year metals going crazy?
Yes, Jared. I think the easiest way to explain it is most markets, including the metals markets, have a propensity to like 90% of the move in the last 10% of the time. That's a metaphor. It's an analogy. But the point being is there's this acceleration phase. And that's where the FOMO, fear of missing out, and there's just a really big push. You see it in real estate. You see the tech wreck, which you're probably old enough to have witnessed, at least maybe as a young guy. And this is normal for the metals market as well. So we have hit what I consider to be the acceleration phase. If you look at what I lived through when I was a young man and the 1979, 1980 bull run for gold and silver, silver went from a $6 January price in 79 to a $50 price in January of 1980. So in 1 year, it was up 850%. If you want to look even closer, if you look at gold, I bought futures, the highest ever gold price ever, $300 the ounce in December 1979. On my birthday, January 21st, 1980, was the peak in gold. So I'm in the right market. And on my birthday, it had hit 850 on the spot market, 875 in the near month. So go from 300 to 850 in a month and a half, and you got like a 2.5 times move in a month or so. Yeah, so that's the tippy top of it. We don't want to see that. But what we are seeing, as you said, about a 50% move in less than a year, basically, or year to date. So 3/4 of a year. And that's, in my view, sort of a precursor to the maximum acceleration phase that I just outlined. Does that mean silver's going up, fourfold from here and gold's going to triple? I don't know. I do believe strongly with my work study and understanding of markets and market psychology, I might add, that we're going to see higher prices in both the metals.
So would you consider yourself a dip buyer in this market on gold and silver? Or are you as allocated as you want to be and you're just riding it out? How are you trading this metals market that we're seeing right now?
Yeah, for me personally, I'm pretty much just holding what I have. I might buy a little more platinum if we get a big enough dip. I put my newsletter, my paid service in April. Do not buy gold. It's going to go sideways for at least the summer, possibly the rest of the year at 3,500, which turned out to be partially true. It went through the summer. In fact, day after Labor Day, it started to move again.
Yeah.
But the best buys are silver and platinum. And that was exactly true. I actually caught the wave almost perfectly on the platinum. And that's been as high as up 70%. It's backed off as well as gold and silver here of late, but not all that much. And so, yes, we've got further to go. So here's what I would say. If you do not have any exposure to the precious metals, buy some now. And the maximum I think anyone should have would be 20% of your portfolio. And that may sound like a lot, but you'll see it for the mainstream now, Jared. As you know, I know you study the markets like I do, maybe even more time than this old man. But if you look at a Harvard study, it's around 20%. And I can't find the Harvard study, by the way. Ibbotson and Associates did a portfolio analysis. Their conclusion under all market conditions, 15%. Under these type of conditions, 20%. And CPM Group of New York, which is a metals specialist. They look at all the metals. Jeff Christian is the general managing partner. From 1968 to present day, 25% weighting in gold for the maximum return on a portfolio. So it's not out of the question to do 20. I usually say 10 because people are pretty happy with 10. They can have NVIDIA and, Tesla and, Amazon. And 10% in gold, what the heck? Gold's not going to do anything until it does. And then they're happy they have it. So I believe in a balanced portfolio. For me, I'm looking at the exit, but not, I think the exit's at least a year and a half, 2 years away. But then it's the big question, all right, gold finally is overvalued. Right now it's getting near fair value. It's not quite even fair value yet.
Yeah.
But what do you do with it, right? And usually there's an opportunity. You've been a hedge fund manager long enough to know that there's something that no one else likes, and we do. And we kind of like it because no one else does.
That's it.
It could be a depressed stock market, could be a real horrible, and I think this one will be almost a lead pipe cinch, and that will be commercial real estate. It'll be your job and mine. I'm not trying to speak for you. I'm just having fun with you. But, there probably is a great way to repurpose some of this commercial real estate and buy it for pennies on a dollar, change it into, I don't know, a gaming headquarters with an AI workshop or something.
For sure.
All of a sudden, it's worth a lot of money again.
So you have so many nuggets in there, but I want to go back one step and say, so given your take on gold, you're not spooked by the pullbacks. We've had quite a little dip in gold and silver off some of the highs. You're holding, you're riding, your time horizon's at least another year.
Yes.
I think that's fair. And then to talk about the other part of what you brought up, right? What in my trading and investing and our approach, catalyst, and I think for most traders, catalyst, you've got to have a catalyst for something. So what is your catalyst? What do you think either makes the metals head higher, makes them head lower, causes major trouble in the economy? There's a lot floating around out there. You mentioned commercial real estate. Is that a big one you're keeping an eye on?
It is. I expect it to manifest in 2026 when some of these rollovers can't be accomplished, or they have to discount the property to meet their debt obligation, or underwater and they merge with somebody. You know the markets. There's lots of ways to get out of a bankruptcy, but still the owner of that debt isn't going to be too happy. So we're going to have to see what takes place. So as far as what I say, as maybe, I don't want to use the wrong adjective, but as the dynamic as it may sound, all fiat fails. The idea being that there's never been a paper currency in recorded history that hasn't really met its maker. And according to Voltaire, all paper currencies reach their intrinsic value of zero. And that's really not true. They move toward zero and sometimes do reach zero. But in some instances, a new system is put into place. And that's what I think will happen here. I think we're going to a digital monetary form, which will basically end, but it'll take on some new characteristics, perhaps with the AI and all that we hear. We might go to a UBI, universal basic income. We might have a different distribution model, probably pushing more toward a socialistic type of environment where, the state has the mandate to take care of more and more people. I'm pretty apolitical. I'm more of a libertarian leaning than anything else, but I don't like to box myself in because I look at both sides and I think they both have merit. One is too logical and one is too emotional. And I try to stay pretty much in the center. But anyway, back to you. I'm sure you probably have a few more questions.
No, I think those are good points. So if you think that the currency that we're using, which history tells us exactly what you said, right? These paper currencies, they end up barely as good as the paper they're printed on at some point, right? And obviously we've had this crypto introduction over the last really decade that it's kind of taken root. How does a metals trader like yourself, investor, look at the crypto space?
Yeah, that's a great one. And if you don't mind, I'll plug a couple things. I wrote, a lot of people trust me as they should, but I'm human. I make mistakes. I'm not perfect, but I am a straight shooter. And David, what do you think? What do you think? And so I wrote a piece in, I think 2016 or maybe 2014, my 2 bits about Bitcoin. And I said, if it's all that it's cracked up to be, it sounds pretty good, especially coming from a libertarian bent. But also being a study of monetary history, I must confess that if it is what it says it is, the governments are going to come in. They want to keep the monopoly on the money masters want to keep the monopoly. And absolutely is what happened. So now Bitcoin has basically become the reciprocal of what it was touted to be. And I wrote a recent article that I published not on X because I'm afraid of getting blocked, but I did put it on my LinkedIn account about basically how it's done a U-turn. It's not anonymous. They can track down anybody. It's not a peer-to-peer payment system. It's much too cumbersome and much too expensive. It's not digital gold. It does not show up on the periodic chart. Its correlation to gold is rather poor. It correlates a lot better with the stock market. And plain and simple, anyone that's got a degree in finance ought to be ashamed of themselves saying Bitcoin's a great investment if they look at the core holding of Bitcoin, which is the way I look at gold when I evaluate a mining company. If a mining company is mining gold at 5,000 the ounce and all I can sell it for is 4,000, I'm a pretty stupid miner. I'm going to go out of business at some point. And that's a metaphor for basically where the Bitcoin miners are at in the United States. You look at Marathon and Riot, they're not making a profit. Now, they do accounting tricks to make it look like they are. But if you do really what I would call forensic analysis and you know how to do basic math, they're losing money or barely breaking even. And that's very apparent in their stock price. It's going down, down, down into the burning ring of fire, and the flames they're raising higher. And that's the truth of the matter. But yet, some of the guys I consider to be pretty damn smart are touting the merits of Bitcoin. Well, good luck. And the other part on, I said I look at both sides. So looking at the logic side, let me give you the emotional side, the way the left might look at it. These things cause a great deal of harm to the environment on a noise-only basis. Many of these data farms, as they're called, or Bitcoin miners, they are very, very noisy, and it disrupts the people that live around that and also the animals that live around it. It's a big water drain, and it's a big energy sink where their utility bills go up higher and higher. Secondly, it's a waste as far as energy is concerned. On my perspective, there's arguments against that, and I've heard them. I'll try to be neutral on that. But let's take it from a hardware perspective and my favorite topic, metals. Those little computers that you buy that have to depreciate in about 2.5 years, become absolutely worthless after that, because they're only designed for one thing, and that's guessing numbers. So you can't give them to, your local school or your local, homeless shelter to, use for sales purposes to get, an income stream or whatever. In other words, you got to throw them away, basically. And that's a waste as far as I'm concerned. So I am not a big Bitcoin guy. I do think that the blockchain definitely has merit, and I think it will be used more and more in the financial system. I also wrote a piece in my private work about the blockchain and how it will be utilized, in my view, to be proposed, as Cantor Fitzgerald guy has already indicated, where they could tokenize everything. The problem with the debt right now is it's really unsecured. It's based on the full faith and credit of the United States. Well, what does that really mean? It means how much they can tax you. And they could tax you at 100%, Jared, and me as well, and they still can't pay off the debt. So now they just print up the difference, and they're not going to tax us at 100%. We would, what would happen then? No one would go to work. So we make up the difference, but it's a losing game. We're not going to win this thing. We are not going to come out on top. However, if you're able to recollateralize the whole debt basis and say that 38 trillion, no problemo. We are going into the national parks and all the land that the federal government owns, and we're going to tokenize every grain of sand, every leaf, every blade of grass, every rock, and every river. And it's worth, pick a number. Let's pick a nice one, 100 trillion. But this 38 trillion is not a problem. We've got collateral that's triple that. Let's go forward with this game of ours.
That's an interesting take for sure. First time I've heard that, but makes you think. Now, on that same vein, we do have a major debt situation. We've got things like gold and silver that obviously has had massive inflows this year, with concerns about that debt side of things. Where do you think that treasuries and bonds play a role here? Are those, in your view, too high risk? Should people still keep that 60-40 portfolio, have some bonds and treasuries in there? What do you think on that space?
Well, I don't talk about the bond market enough because it's what I call the keys of the kingdom. I mean, everything in finance, as you know, revolves around debt, or what we call credit, two sides of the same coin. And because of that fact, the full faith and credit of the United States is a misnomer, as I just explained, yet the whole financial system believes it, or pretends to believe that it's the sacrosanct investment of all time. There's nothing safer than the debt of the United States of America. But this isn't true. And because of that, we've seen that China has backed off their purchasing. Japan has. Most of your nation states have backed off the amount that they purchase. In fact, they're buying gold instead. And recently, their gold holdings, in some instances, for some central banks, are greater than their treasury bill or treasury holdings across the board, bills, notes, and bonds. So this is telling us, screaming at us, really, if you know what to look for, that the debt markets are not being trusted. And when that whole system is based on confidence or trust, and that trust is being lost, not given up, but being lost slowly and now more rapidly, we are seeing the end is nigh. And that's why I think the allocation to the precious metals should be greater. I said the run to gold has begun, meaning the last phase, that acceleration phase. And I said that about 2 years ago, and the metaphor I used, Jared, was this. It starts off like a sprinter. You start out, like going to a sprint. Start off with a light walk, and then a brisk walk, and then a light jog, a full jog, a running jog, a light run, a full run, and then an all-out sprint. And that's the acceleration phase. Right now, I would say we're at the light jog to jog phase. The banks have been buying gold hand over fist, but that's the smart money. They know what's coming. Do they plan to tie gold to the new monetary system? I think not. However, it is the money of last resort. It is money for the last few thousand years. And if necessary, they have it available. Again, I don't think they will tie the new monetary system. I think it will be the modern money theory. I think they'll reset with a new number one way or another and issue basically the beta test that China's been on for several years now. Everything will be digitized and you won't have financial freedom anymore. You'll have financial freedom if and only if your social credit score is aligned with Big Brother.
Yeah, good point. Good point. So what about, I mean, we have to bring up our good buddy Warren Buffett, right? And what does he say about, or actually, what is your response to what he says about gold? And he says, you know, gold doesn't produce anything. Gold is just gold. It's perceived value, right? As opposed to a stock that has earnings and dividends and growth in that sphere. What do you respond to that?
Yeah, I wrote a piece on that and I put it in a booklet when I was just getting started on the speaking circuit. And I forget what I even titled it, so I'll make up a good one, but it's something about the real story behind the Buffett syndrome or something. And what I pointed out was that, Buffett's father was a senator and he was a hard money guy. Buffett's dad was pro-gold, and yet Warren isn't. So maybe he has a father problem. I don't know. What's interesting is what he says about gold. I would agree with some of it. I mean, I am more of a silver bug than a gold bug, and I don't consider myself to be a metals bug at all. I consider myself to be astute enough to understanding the times we live in that it takes this kind of action. I'd much rather be in a sound monetary system where I'm a true capitalist and I'm buying more in the up and coming technologies, foodstuffs, the real economy, because really all I'm doing is saving real money for the future so I can make those purchases, delay them for future times, because right now the money's being debased so quickly. But no one really ever brings up the fact that Warren is a real big silver bug. He's been in the silver market several times. A couple times he's got his hand spanked. And this last time, it's conjecture on my part, but the numbers line up. I had a friend that called that was a whale, very upset with me because I had talked about how much silver was in London. And he had been there, or one of his people, and there was a lot more than I had indicated. So I called up Jeff Christian of CPM Group and had a nice chat with Jeff. Jeff said, "Oh, well, that's Warren Buffett's silver." I said, "Oh, that 130 million ounces of silver that Buffett bought off the exchange, which is 25% of the free float in the COMEX, got shipped to London?" "Yes, sir, it sure did." "Well, then what happened?" JP Morgan started the SLV. "Oh, that's wonderful. Where did it start?" "Well, guess what? London town." "And guess what else, Jared? It started with 130 million ounces of silver." What a coincidence.
How convenient, right?
Right.
That is super interesting, and those are good points. I think everybody is certainly scratching their heads on what that next thing is right now, right? Because I mean, for how long was like a 60-40 portfolio really just generally a terrible idea? And then that got great with an interest rate hike, and gold had really fallen out of favor for a while. And then, more than certainly just the last year, the last couple of years, gold has really had a resurgence, right? And Bitcoin is sitting at these all-time highs, and people are trying to discuss how that fits into their portfolio. And so I think we're in this interesting place, right? Where there's a combo of, is the old the new, or is the new, right? What is the way forward? And I think it's an interesting point that you bring up of gold and silver being tokenized and going into more of a digital kind of a space there, right? And certainly, I think Bitcoin has probably surprised more people than not. I mean, by far, right? That this value that people see there is also limited, right? Kind of like gold. And we have these currencies, these fiat currencies around the world that just, certainly the US, we just, hit the print button. Let's go. Let's just keep adding to it. But remember, we're backing it, right? And everybody, and it sort of feels sometimes like there's this, I'm sure people wanted to believe Bernie Madoff. Hey, we got a lot of money with him and he's telling us stuff. It does us good to believe what he's telling us because we've got a lot of money with him, right? And there's certainly that sense of where debt is going. I mean, I think that's on the top of everybody's minds, right? We have this the national debt, individual debt, right? We're seeing private credit really starting to bubble. That's kind of one of my key areas that I'm watching. And there's trillions out there in private credit that is kind of, people are hoping things work out, right? And so when we think about all that, and the debt and how we handle it, if we go off historical context, things have always kind of worked out, right? What do you think is the thing that stops things from working out? When do we hit that wall where it's like, there's nothing we can do?
I would say the answer to that, Jared, is free market capitalism really doesn't exist. Remember, in a true free market, you have the right to succeed, but it also means the right to fail. And in a true free market, if you come up with a widget and you're going to make $1 million a month on it because everybody wants it, and you put in capital and you get your brothers and sisters, or you start a public company and it's a stock that can buy and they can invest in your idea, and it fails, it fails. The market has spoken louder than you. It might have been a great idea. And it might only take a tweak or two and you put it back on the market and you are a success. But regardless, you need the right to fail. And if you start to reward failure, you're not in a free system, which means it distorts. And that's where we're at. So for the market to clear, what we need is to admit the truth. And that is, there's been a huge misallocation of capital for the last 50 years or more. And that's accelerating. We get, when you get NVIDIA up to, more than several nation states in the world as far as market cap is concerned, you got to kind of scratch your head and say, no, wait a minute. I remember early on, I'm much younger than you, I'm much older than you, you're much younger than I meant to say. But when the Emperor's Palace in Japan was worth more than all of the real estate in California. And that point was hit. And I go, that's it. That's the top. So I think we're approaching that now. So let's go a step further. The function of a financial collapse is not to make everyone poor. It's not to scare everybody. The purpose of a financial collapse is to reallocate what exists and reprice it. So let's think this through as a thought experiment. Because whenever you say financial collapse, most people jump to an emotional side of their brain and say, oh my goodness, everything burns to the ground and there's nothing left. But in a real financial collapse, everything stays in place. All the wealth is still there. All the office buildings, all the commercial real estate, all the farms, all the ag products, all the oil wells, all the shipping lanes, all the ports, all the automobiles, all the churches, it's all there. So if that part of it doesn't change, what does change? And the answer is it gets repriced. People that were over leveraged in debt that own those office buildings are selling them to you and I at 10 cents on the dollar, and we are going to put office workers in there or maybe repurpose them, as I indicated earlier. But things come back to a more sound footing as far as what the value is, not the price. People know the price of everything, but not the value of almost nothing. And that gets more on a philosophical level, which we could talk about at the end because I did a documentary on that idea. But coming back to your exact point, we need the market to clear. We need the market to be free to find out what, as I have my favorite expression these days, who's who in the zoo. What the real price of a car, of an RV, of an automobile, of a house, of raw land should be relative to the true value, or the what we could call in an Austrian school the true money supply. Not the debt market, not the credit market, not the bubble.
So you've indicated that you're keeping an eye on commercial real estate. Is there any other part of the market that you think is maybe more overvalued than another?
Well, I think AI is the most overvalued right now. And yeah, technology in general, but it's hard. You can't really do a PE on a tech stock very easily. But I just think the general belief that, things will only get better and technology will save us is a misnomer. It's really the hardcore things that save us. That's why I've leaned toward the commodity sector my whole life. because that's what you need, not what you want. So in the great restructuring, you'll find anything that has debt attached to it will probably deflate. So automobile loans, housing loans, anything that's based on debt to get the final product, which is mostly real estate, automobiles, school loans, something that needs a loan behind. Anything that's a need, like an ag, like, the softs, cotton, cocoa, coffee, or wheat, corn, soybean oil, all that stuff will probably go up in price. Beef, and that's what we're seeing at the grocery store. So there'll be a repricing of what the value is. We've got to eat. That costs more than it used to. I don't have to have a McMansion that I can't afford the heating on because my electric bill's up double. And so you'll see more of a deflation on that side of the equation. Of course, as an Austrian, you're not supposed to have a deflation and inflation at the same time. So they came up with a new word called stagflation. But I think that's the idea that I see happening. Doesn't mean it's, in fact, I think in the long run, and putting the spiritual side of things on it for a minute, Jared, if you allow me, is that actually I think it's a good thing, because I think we need this cleansing, this financial cleansing, which at the same time I think would be somewhat of a spiritual cleansing on really revaluing. Am I really happier with, a 10-bedroom house than a 4-bedroom house? Am I really happier with, an exotic car than one that just gives me transportation? And those are individual things, but collectively, we tend to go with a meme, as the words are used now, that, well, my neighbor has it, then I better have it because, he's happier than I am because his car is shiny. And that's really a bunch of nonsense. But a lot of people get caught up in that.
So you are definitely kind of, you see, and you're leaning into just the good old hard commodities, right? Not necessarily commodities, so to speak, but the items that are tangible, right? The tangible goods, as opposed to, an AI stock that's trading at however many hundreds PE that it that it may be trading at. You're going for gold as opposed to crypto, right? And kind of betting on that side of things, which of course I think everybody can agree that in the long term, that's probably the safest bet. But there's always the question of what happens between now and the quote long term, right? Are there missed opportunities in there? What's the opportunity cost of taking because I think that's easy to agree on that's the safe bet for sure. But the opportunity cost associated with that. How do you think about that?
Yeah, I think about it in the way I started the report. And that is exactly what you said. We only need 20% in my sector, and 80% could be in a tech stock, or it could be in commercial real estate, or it could be in whatever you want. I'm not trying to dictate you must be 100% on hard assets. I'm more like 10 or 20% and do with what you will with the rest. But you must have something in the hard sector under these trying times, I'll put it, because if things go the direction that they seem to be headed, that 10% exposure to gold will make up for a complete loss of everything else. Is real estate going to go to zero? No. Does land ever go to zero? No. The stocks ever go to zero? Some do. But, you could have a very big market pullback, 50%. And if you were in the S&P, you would have lost 50%. But at the same time frame, or very near the same time frame, gold may be up 400%. So that 10% exposure acted as if it was 20 or 30% of your portfolio. So I think you should have balance, but I don't think you need to be all in. So as far as myself personally, yes, I'm above that percentage, but I still have some real estate. I mean, made a lot of money in the cellular phone industry. That was the high tech thing when, I was a 25-year-old. I brought the idea to my dad, and we started a small company to put engineering together to put out license applications for the cell phone industry. So I'm not a one-way only gold bug from the beginning. As I said earlier, I'm really more of a, let's have a win-win. Let's have a capitalistic entrepreneurial idea of a new, new fast food place that's so damn nourishing, but tastes better than anything else out there. You get your milkshake, whatever. But I'm of that mindset. I love business, and I just save in metals because I want to have the ability to pass on to my kids or granddaughter or whatever to hopefully get to the new paradigm that I'm talking about, where we've repriced things in a more efficient manner and we're not wasting money as much as we have in the past.
It's very timely for sure, and being at least 20%, if not more, which I think there's an argument to be made there as well. Why not more? Why not 50%? Right? Why not somewhere in that range? But certainly timely to be heavy in the hard assets. We're in this interesting spot where kind of everything's going up, right? It's kind of an everything bull market, and so there's the arguments everywhere that it's the smartest to be in these, AI stocks, these tech stocks. It's smart to be in commodities. Smart, everything's going up, right? But it's always the in the correction, where do we want to be positioned? And I think that's a very interesting point. Kind of just reminding everybody the classics, right? Of gold, silver, hard assets, the tangibles. Because
I want to circle back to something you said. Sorry if I interrupted, but you said, well, it's really good in the long run. And, you weren't arguing with me. I just want to point out for your listeners, and most probably know this, but it bears repeating, legacy investments. There's three for all time. So going back to the 15th century, what do you do if you want to put in a legacy for your family going forward? Land, gold, and fine art. It's those three. The Europeans say never sell the mud. In other words, if you own a city block in Berlin, that may go from a grocery store to an apartment building to an AI center or a data center, but you own the mud. You never sell the land. The improvement, you could lease out, you could let someone else build it, you could own it yourself, whatever. So land is one, gold is another, because why? It's money. It always has been, and it will probably still be in the future. And then fine art is certainly out of my category, and maybe out of yours. I'm not of the means to buy a Rembrandt or a Monet or anything like that. But if you are in that class and you want to pass on legacy wealth, that is another way to do it. So it's those three. So as you said, I don't think you were a classic, or maybe you just said it. But yeah, that's classic wealth. But does that mean you shouldn't be an innovative entrepreneur and say, God, sure, it's got the best idea I ever heard of, man. That new system he's got for trading is killing it, man. I want in on it. Sure, of course, do that. Have a little fun, have a little spice with it. I look at the metals like gold is the S&P 500 and silver's the NASDAQ. I mean, they do have different personalities, but they're both stocks. Of course, they're both metals, but you get my point.
Sure. No, that's great stuff. Well, again, it's very timely to be discussing this, and thank you so much for sharing your points of view on everything. I think these are will land very well with our listeners, and people will have a good reminder that obviously we're watching these things go up, but what is the bigger picture in the bigger context? So that's great stuff. Tell people where they can find you, where they can follow you, where they can learn more about what you're doing.
So the main landing page is themorganreport.com. There's a free letter put out. Usually it's just interviews like this that are public domain. Send them to your mailbox. And then I have a paid service, which you can get on if you care to. You can just get the tab, read about it. There's a video and a sales letter. And then it's very lenient, meaning you can subscribe for 60 days and decide it's not for you and get your money back. So a lot of people, I would just caution everyone, if you give me another couple minutes, to not buy my service if you are not familiar with the financial newsletter industry, because some people expect too much. People that know the industry are very pleased because the product that we put out is, excuse the ego, but it's better than most that are out there. But also, it's not like, a general fund manager would be where, give me your money, I manage it for you. We don't. I show you, looking over my shoulder, what I invested and why. Also do some timing on the market, but it's for that 20%. Say, I'm real happy Jared manages 80% of my money, but David makes sense. Jared's really not exposed to the commodity sector as much as David is. I'm going to do 20% with him. That's the idea. Now, I have to admit, there's many people that are what I'll call metals heads that probably are 50% or something. But that's their choice. But as far as my recommendation, 20% or less.
Gotcha. I think that's great advice. Well, thanks again, David, for being on. We appreciate all your knowledge you've shared. I think you've been in the markets for probably longer than many. So, so keep up the good work. We'll post all of your socials and everything in the show notes below. But thanks for watching, everybody. And David, thanks again for your time. We appreciate it.
My pleasure, Jared. Thank you.